Well, our guess is they're going to have to start cutting pretty early in the year. But we have two stages to the cuts. One is, they do have inflation falling a lot faster than they expect. So at some point, they should be adjusting the nominal funds rate to prevent it from getting increasingly restrictive in real terms, right? I mean, if inflation's falling, real rates are rising. John Williams has talked about this, Chair Powell even in the September press conference. So we think as early as March, they should probably start, at least calibrating the nominal funds rate. So that's the first part, I think, of the sort of two stages of 24 for the Fed. The second is when the unemployment rate starts to rise. And typically in the U.S., that does tend to be pretty disinflationary pretty quickly. And central banks tend to react pretty strongly in the U.S. To increases in the unemployment rate or contractions in the labor market. So I think by mid-year, they're going to go from talking about calibration to accommodation in order to sort of prevent worst-case outcomes for the economy.
Well, the thing is, obviously, the Fed do have that dual mandate, to your point, which is why they're responsive to those slightly higher unemployment rate figures. Let me just bring it back to where you think this rate cutting cycle, where rates are ultimately going to end up, because there's been a lot of discussion the last couple of years that this natural rate or the R star rate, neutral rate rather, is higher than it was pre-crisis because of so many other different factors, structural factors, which mean that ultimately, there are reasons, demographic reasons, technological reasons why an economy would need to sustain higher interest rates. Are you of that view as well? And do you think that the new neutral rate is higher than it was in the past?
So I'm open to the idea that the neutral rate could be higher than the past. I think at the moment it's really difficult to know what's happening with the neutral rate because essentially the rate hikes I think have been fighting a very large fiscal impetus in the U.S. So fiscal policy has been very expansive in the U.S. It's driving a lot of outsized growth performance across a number of industries and consumer spending. So the Fed's really trying to fight this other strong force pushing the economy forward. So I don't know if we're really learning in real time, what our star is. We do have some of the same forces that push down our star in place. Population aging, productivity trends do seem still in line with pre-COVID. I'm open to the idea that maybe there has been a structural shift higher, and I'm also open to the idea that we've got an AI revolution and other advancements that could really drive outsized potential growth in the years ahead. I just think it's too early to be seen. So I'm still of the camp that short run, our star is probably higher. Medium, long run, I think we'll have to see. But we do still have many of those forces that put downward pressure on the neutral rate in place going forward.
Do you see any signs of credit stress popping up in the system? I mean, I know we had, regional banks flare up at the beginning of the year, but that was largely contained, and I think, supervisors, regulators were quick to act at the time. But one of the observations that I've heard having discussions with other economists, they say, look, because monetary policy works with a lag, it's going to take time for the full impact of this, 5% plus base rate to be fed out to the broader economy. We talk about, credit card debt sitting at more than $1 trillion for households. Is this a ticking time bomb? Should we be worried about potential credit stress showing up in the system next year?
Well, I worry about everything, right? So as an economist, that's sort of our nature. It's hard to look at it and think of it as a systemic, systemic risk. I mean, I don't think we're facing the next GFC, but I do think that's an important reason for the lags. When we look at whether it's the Fed's Senior Loan Officer Opinion Survey or other bank surveys, there's widespread reports of credit tightening. And that tends to lead loan growth by 2 to 4 quarters. So I do think we're still waiting to see much of the impact of that credit tightening. Now, some of that could be fallout from regulatory concerns after Silicon Valley Bank, but some of it is going to be the natural side product of a rapid 500 basis point hiking cycle. So I think we are still waiting to see those credit headwinds dampen activity in 2024.